524 million ounces. That's the amount of silver currently sitting inside the iShares Silver Trust right now. 524 million ounces of physical metal supposedly backing every single share of SLV. That represents 16,305 metric tons. That's more silver than the entire annual mining production of the planet. And on Monday, as silver crashed 9.5% in a single session, as mainstream media ran headlines declaring the rally dead, as the CME raised margins to force out leveraged traders, do you know what happened to those 524 million ounces? Nothing. They sat there untouched, unmoved, because the institutions who own that metal, the funds who have accumulated that position over years of patient acquisition, they didn't sell. They watched the paper price crash from $83.62 to $71.66, and they didn't flinch. They watched forced liquidations cascade through the futures market, and they held their ground. And today, as silver rebounds 5.7% to $76.34, as SLV jumps 3.5% in early trading, as the miners start to recover, we're seeing the truth emerge from the chaos. The manipulation attempt failed. The margin hike created a one-day crash, and now fundamentals are reasserting themselves. What we're witnessing right now could be the most important week in the silver market in over 4 decades. We have Fed minutes coming in hours. We have China's export restrictions tightening. We have the dollar in freefall. We have year-end liquidity vacuum creating explosive moves in both directions. And we have 524 million ounces sitting in a single ETF telling us that institutional money has already taken its position. Before we break down exactly what happened, make sure to smash that like button for more precious metals market analysis, comment your perspective on this volatility, and subscribe so you catch every update on this developing story. Let me walk you through exactly what happened in the last 48 hours, because mainstream financial media isn't providing the full story. They're giving fragments. They're showing the crash without the context. They're reporting the margin hike without explaining what it actually means, and they're certainly not discussing the 524 million ounces that didn't move during the entire episode. On Monday, silver experienced one of the most violent reversals in its trading history. The metal touched $83.62 in early trading, a new all-time record high. Then it crashed. By session's end, silver had fallen to $71.66. That's a 9.5% drop from the high. That's nearly $12 in a single day. The headlines were immediate and unanimous. Silver crashes, rally over, bubble pops. Every financial network, every mainstream outlet, every analyst who has questioned the silver move for the past 3 years suddenly had the same message. I told you so. It was too high. The correction was inevitable. But here's what they didn't report. They didn't mention that the CME Group raised margin requirements on COMEX silver futures by 13.6% on Friday, effective Monday morning. They didn't explain that this margin hike forced thousands of leveraged traders to either post an additional $3,000 per contract or face automatic liquidation. They didn't note that this happened on the thinnest trading day of the year during the holiday week between Christmas and New Year, when liquidity was at its lowest and price moves would be amplified. They didn't acknowledge that this is the exact playbook exchanges have used in 1980 and 2011 to suppress silver rallies at their peak. The margin requirement functions as a security deposit. When trading futures, you don't put up the full contract value. You put up a fraction, typically 10 to 15%, as collateral. This leverage allows control of large positions with relatively small amounts of capital. But it also means that when the exchange raises margin requirements, you need more cash immediately. If you don't have that cash, your position gets liquidated. The exchange doesn't call and ask politely. The exchange doesn't provide a grace period. The computer sees the account is underfunded and sells the position into the market at whatever price is available. When this happens to thousands of traders simultaneously, when they're all forced to sell at the same moment, price crashes. This isn't natural selling. This isn't profit taking. This isn't rational assessment that price is too high. This is mechanical, forced, indiscriminate selling created by a rule change designed to produce exactly this outcome. The CME raised margins from $22,000 to $25,000 per contract. That's a 13.6% increase. Every trader with an open position needed to find an additional $3,000 per contract by Monday morning or face liquidation. But here's what the banks didn't expect. Here's what the CME didn't anticipate. Here's what mainstream media cannot explain. The price bounced immediately. Not in a few days, not after consolidation, within 24 hours. Silver is now trading at $76.34. That's up 5.7% from yesterday's close. That's a $4.68 move in a single session. The SLV ETF is up 3.5%. The miners are recovering first. Majestic Silver up 0.8%. Pan American Silver up 0.9%, Wheaton Precious Metals up 0.7%, even gold is participating, with SPDR gold shares up 0.8%. This is not what happens when a bubble pops. This is not what happens when a rally ends. When a genuine market top forms, when buyers are exhausted and sellers take control, you don't see a 5.7% rebound the very next day. You see follow-through selling. You see lower lows. You see capitulation as participants realize the trend has changed. None of that is happening. Buyers are treating Monday's crash as a gift, as an opportunity to accumulate at lower prices before the next leg. The fact that price has already recovered more than half of Monday's losses tells the story about underlying demand. Now let me discuss the 524 million ounces, because this number is crucial for understanding what's really happening. BlackRock's iShares Silver Trust, ticker symbol SLV, is the largest silver ETF in the world. It holds 16,305 metric tons of physical metal stored in vaults to back the shares. So what happened to those 524 million ounces during all this chaos? Did they leave the vault? Did BlackRock start selling physical metal to meet redemptions? Did authorized participants break down the baskets and drain the trust? The data indicates no, the metal stayed. The 524 million ounces are still there, which means that despite record trading volume, despite panic in the futures market, despite margin calls and forced liquidations, holders of physical silver through SLV didn't sell. They absorbed the volatility, they held their positions, they watched their portfolio value drop by nearly 10% in a single day, and they didn't hit the sell button. This is remarkably important information. This suggests that the ownership base of silver has fundamentally changed. This isn't the speculative money of 2011 that exited at the first sign of trouble. This appears to be long-term capital. This suggests strategic allocation. This indicates money that understands fundamentals and has conviction to hold through drawdowns. Let me give you the quote that matters. David Meagher, Director of Metals Trading at High Ridge Futures, stated today, and I quote, "I believe that the underlying fundamentals of supply constraints remain factors in the market, and we still have positive prospects going into 2026, end quote. This is a professional trader, someone who makes his living understanding metals markets, and he's stating on the record that fundamentals haven't changed. Supply constraints are still there. The positive outlook for 2026 remains intact. Monday's crash didn't alter the equation. It was a volatility event within an ongoing structural trend. The market is already indicating that by recovering so quickly. The 153 million shares that traded were being transferred from weak hands to strong hands. The sellers were leveraged futures traders who got margin called. The buyers were institutions and individuals who recognized artificially low prices as accumulation opportunities. The composition of the shareholder base potentially improved during the crash. The participants holding silver today may have stronger conviction than those holding it Friday. Hit that like button if this analysis is helping you understand what really happened. Drop a comment with your thoughts on the SLV data and subscribe for continued coverage. Now we need to discuss China because news that emerged overnight changes the context. China's Commerce Ministry announced that 44 companies will be allowed to export silver in 2026 and 2027. This is part of China's broader controls on critical minerals. The export list has only 2 more companies than in 2025. 2 companies, that's it. Mainstream media tried to spin this as China loosening restrictions. They attempted to make it sound like supply was about to flood the market. That interpretation appears incorrect. Adding 2 companies to an export authorization list is not a loosening of restrictions. It's a continuation of the same restrictive policy that has been in place. China is the world's largest producer and consumer of silver. They need the metal for their own industrial economy, for solar panels, electronics, electric vehicles. They're prioritizing domestic consumption. The fact that only 44 companies are authorized to export indicates Beijing is maintaining tight control over where their silver flows. This is resource nationalism. This is exactly what market analysts have been projecting. As the world fractures into competing blocks, as relationships between China and the United States remain adversarial, free flow of critical materials is ending. Silver is no longer just a commodity. It's increasingly viewed as a strategic asset. And strategic assets don't flow freely across borders during periods of great power competition. Let me connect this to the broader macro picture, because what's happening with silver is a symptom of a much larger dynamic. The dollar index is on track for a 9.6% annual drop. Let that sink in. The reserve currency of the world, the currency that's supposed to be the ultimate safe haven, the currency that underpins the entire global financial system, is having its worst year in 8 years. A 9.6% decline. That's a crash in slow motion. That's the market signaling that something is fundamentally shifting in the American economic model. That's capital flowing out of dollar-denominated assets and into alternatives. And what's the ultimate alternative to fiat currency? What's the asset that has been money for 5,000 years? What's the asset that cannot be printed, cannot be debased, cannot be defaulted on? Precious metals, gold and silver. This is why silver is rallying. This is why gold is rallying. This is why mining stocks are outperforming. The market is repricing hard assets against debased currency. The margin hikes, the forced liquidations, the media panic, none of it can change the fundamental reality that the dollar is losing value relative to tangible assets. Now we have Fed minutes coming at 2 p.m. Eastern Time. This is the release of detailed minutes from the Federal Reserve's December meeting, and traders are pricing in 2 rate cuts for next year. 2 cuts. After everything communicated about inflation being sticky, about rates staying higher for longer, about need for continued restraint, the market is betting the Fed is about to pivot. And what happens when the Fed cuts rates? What happens when they signal the tightening cycle is over and easing is beginning? The dollar typically falls further. Bond yields decline. The opportunity cost of holding non-yielding assets like gold and silver decreases. Capital flows into precious metals as assets that cannot be devalued by monetary policy. This is why the Fed minutes matter today. If minutes confirm a dovish bias, if they suggest the committee is more concerned about economic weakness than inflation, if they hint at rate cuts coming sooner than expected, silver could move significantly higher this afternoon. The industrial demand picture is another pillar that mainstream media doesn't discuss comprehensively. The Associated Press, not exactly a fringe publication, cited rising usage in solar panels and data centers as a key driver of silver's multi-decade highs. Solar panels use silver in photovoltaic cells that convert sunlight to electricity. Every single solar panel installation globally requires silver, and the world is installing solar panels at an exponential rate as governments and corporations race to meet climate targets. Data centers represent another massive demand source. The artificial intelligence revolution requires enormous computing power. That computing power requires data centers. Those data centers require silver in servers, connections, electrical components. Every time someone uses ChatGPT, runs an AI model, streams a video, or sends an email, they're using a data center that contains silver. This demand isn't going away. This demand is accelerating, and it's colliding with slowing mine production. The easy silver deposits have been mined. New discoveries are deeper, more remote, more expensive to develop. It takes 10 to 15 years to bring a new mine online. Supply cannot respond quickly to rising demand. The only mechanism that can balance the market is price, and price must rise until demand is rationed or new supply becomes economically viable. Neither of those things happens at $76 silver. Price needs to move substantially higher before the supply-demand equation balances. Let me address the volatility directly, because I know Monday's crash concerned many market participants. Some are wondering if they should exit positions, take profits, reduce exposure before the next crash comes. Let me provide perspective. Silver is not a stable asset. It never has been and never will be. It's a small market. It's dominated by a handful of large players. It's subject to manipulation, margin hikes, and forced liquidations. If you cannot handle 10% drawdowns, this market may not be suitable. But here's the dynamic. The volatility is the cost of the upside potential. The same characteristics that allow silver to crash 9.5% in a day also allow it to rally 15% in a day. The same thin liquidity that amplifies downside also amplifies upside. The 5.7% rebound today is the market indicating fundamentals are intact. It's the market signaling that forced sellers have been exhausted. It's the market showing there are buyers waiting at lower prices who view any dip as opportunity. The thin year-end liquidity cuts both ways. It amplified Monday's crash and it's amplifying today's rebound. We're in the most illiquid period of the entire year. Professional traders are on vacation. Institutional desks are running skeleton crews. Algorithms are programmed to reduce risk exposure heading into the new year. This means every order has outsized impact on price. This means trends, once they start, can extend further than anyone expects. The crash extended further than it should have because of thin liquidity. The rebound could extend further than expected for the same reason. Make sure you're smashing that like button. If this volatility analysis is valuable, comment your perspective on Monday's crash and recovery, and subscribe for updates as this situation continues developing. Let me give you the numbers that matter going forward. First resistance is at $80, the psychological round number that was just lost. Second resistance is at $83.62, Monday's record high. If we can close above that level, next targets are $90 and then $100. On the downside, support is at $75, which we're currently above. Below that, support is at $71.66, Monday's low. Below that, the critical level is $67.50, which would represent a genuine trend change if broken. We're currently much closer to testing resistance than support. The path of least resistance appears to still be up. With the catalysts lined up, Fed minutes this afternoon, thin liquidity continuing through the week, strong hands accumulating while weak hands have been flushed, the probability of testing the highs before testing the lows appears substantial. The dollar's 9.6% annual decline is the macro story that ties everything together. This isn't a silver story in isolation. This is a dollar story. This is a fiat currency story. This is a story about the end of American monetary hegemony and the repricing of real assets against paper promises. Silver is just the most volatile, most leveraged, most explosive way to express that view. When the dollar falls 9.6%, In a year, when the steepest decline in 8 years is happening, when the reserve currency of the world is losing credibility at this rate, capital has to flow somewhere. It cannot sit in cash that's being devalued. It flows into alternatives: gold, silver, commodities, foreign currencies, anything that cannot be printed by the Federal Reserve. This flow isn't going to stop because of a one-day crash. This flow could accelerate because the conditions driving it are intensifying. The Fed minutes at 2 p.m. could be the catalyst that accelerates this flow today. If minutes reveal the committee is seriously considering rate cuts, if they show more concern about economic weakness than inflation, if they suggest the tightening cycle is truly over, the dollar will likely fall further, bond yields will decline, and precious metals will rally. The market is already pricing in 2 rate cuts for next year. The question is whether minutes confirm that expectation or exceed it. If they exceed it, if they suggest cuts could come sooner or be larger than expected, the move in silver could be explosive. We're already up 5.7% before the minutes. We could add another 5% this afternoon if the news is dovish enough. As we head into 2026, I want to emphasize this week's lessons. Remember how it felt when silver crashed 9.5%. Remember the fear that mainstream media tried to instill. Remember the 5.7% rebound that came 24 hours later, demonstrating that manipulation was temporary and fundamentals were persistent. This experience will serve market participants well in months ahead. This mental framework will allow navigation of future volatility. The 524 million ounces in SLV aren't going anywhere. Industrial demand isn't going anywhere. The supply deficit isn't going anywhere. The dollar decline isn't going anywhere. All of these forces are pushing in the same direction, and margin hikes cannot change that direction. They can only create temporary pullbacks that become accumulation opportunities for those who understand the bigger picture. The market is looking at 2026 now. Positioning is resetting. Weak hands have been flushed, strong hands are accumulating, catalysts are lined up, and price is already recovering. The bears threw everything they had at silver on Monday. They got the margin hike they wanted. They got the forced liquidations they needed. They got headlines declaring the rally dead. And what do they have to show for it? A 24-hour crash that's already more than half erased. The bears are exhausted. They spent all their ammunition on a single day's battle, and they failed to change the war. Price is still above $75. The trend is still up. The 200-day moving average is still rising. Fundamental demand is still accelerating. Supply is still constrained. What exactly did they accomplish? They shook out some weak hands. They created accumulation opportunities for strong hands. They confirmed that manipulation exists but cannot overcome fundamentals. That's not victory. That's a confession of weakness. This is not the end of the structural move in silver. This is potentially the beginning of the next phase. The phase where manipulation attempts become less effective, where the paper market loses its ability to dictate to the physical market, where price finally reflects true supply-demand fundamentals instead of fictional claims of over-leveraged futures contracts. We're entering that phase right now. Monday was their best shot. It lasted 24 hours. The setup for January is extraordinary. We have the overhang of forced selling cleared out by Monday's crash. We have a rebound in progress that's recaptured more than half the losses. We have the Fed potentially pivoting to rate cuts. We have the dollar in its worst year since 2017. We have China restricting exports. We have industrial demand accelerating from solar and AI data centers. We have mine supply stagnating. We have 524 million ounces sitting in SLV held by investors who didn't sell during a 9.5% crash. Every single factor is pointing in the same direction. The only question is timing, and with thin liquidity persisting through New Year's Day, the timing could be sooner than anyone expects. Before we wrap up, make sure you've smashed that like button one final time, drop a comment with your thoughts on where silver heads from here, and subscribe so you don't miss the next update as this story continues to develop. This is the silver market update. Monday was the stress test. The fundamentals passed. The recovery is underway. See you in the next one. In the